Okay, let's go ahead and look at the effect of stock dividends and stock splits. Now, stock dividends are additional shares of a company's own stock given to stockholders as dividends. A stock split is a large stock dividend that includes a reduction in the par or stated value per share. So let's say you own 100 shares and assume a 10% stock dividend. You will receive 10 additional shares. If you assume a 20% stock dividend, you will receive 20 additional shares. If you assume a 100% stock dividend, you will receive 100 additional shares. The first two are a small stock dividend. The bottom one is a large stock dividend or stock split, which is known as a 2-for-1. Let's look at stock splits or large stock dividends. A stock split reduces par value per share and increases the shares outstanding. If that happens, there's no need to record a transaction. Now, large stock dividends, on the other hand, they record a decrease in retained earnings and an increase in common stock, which is recorded at par value. So this is what that journal entry would look like. You will debit stock dividends. This is reducing your retained earnings. In this case, the par value is 1 cent per share, and there are 1,000 shares. And you will credit common stock. This is recording a 100% large stock dividend. Let's look at an example. This is a stockholder's equity before and after a 2-for-1 stock split accounted for as a 100% stock dividend. Now, if you look at the before, the preferred stock is $30,000 and the common stock is $10,000. The additional paid-in capital is $40,490, bringing the total paid-in capital to $70,500. The retained earnings is $29,500, so the total stockholders' equity is $100,000. The common shares outstanding are 1,000, and the par value per share is 1 cent. The share price is $30. After 100% stock dividend, the preferred stock remains the same, but the common stock has doubled to 20. The additional paid-in capital remained the same, but the total paid-in capital went up by $10. The retained earnings went down by $10, bringing the total stockholders' equity again to $100,000. The common shares outstanding is now 2,000 shares. The par value per share is still 1 cent per share, and the share price is $15. Let's look at the effects of a stock split and a stock dividend. For a stock split, the total stockholders' equity has no change, common stock has no change, retained earnings has no change, and the par value per share decreases. For a stock dividend, the total stockholders' equity has no change, but the common stock increases and the retained earnings decreases. The par value per share has no change. Let's look at an example of American Eagle's stock split in the notes of their financial statements. On November 13th, the company's board approved a 3-for-2 stock split. The stock split was distributed on December 18th to stockholders of record on November 24th. All share amounts and per share data presented herein have been restated to reflect this stock split. Now let's look at small stock dividends. These are recorded at market value and not par value. It does not change the total assets, total liabilities, or total stockholders' equity. It decreases one equity account, which is retained earnings, and increases 2 other accounts, common stock and additional paid-in capital. Here's an example. The stock dividends were 1,000 of them at 10% at $30, or $3,000. The common stock is 1,000 at 10% times a penny, so the credit is $1, and the additional paid-in capital is the difference, the $2,999. Declaring stock dividends and stock splits is like cutting a pizza into more slices. Everyone has more shares, but each share is worth proportionally less than before. So let's look at a concept check. A company has 1,000 shares of $20 par stock outstanding and issues a 2-for-1 split. How many shares are outstanding after the split? If you chose B, you are correct. Now, if a company has 1,000 shares outstanding and they issue a 2-for-1 split, they would have 2,000 shares outstanding after the split, but each share would be worth about half as much.